If you're watching this video right now, you need to understand something critical. The money sitting in your bank account isn't as safe as you think it is. And I'm not talking about some distant future scenario or theoretical risk. I'm talking about what's happening right now behind the scenes in the global financial system. What I'm about to share with you is going to challenge everything you've been told about keeping your money in the bank. But stick with me, because by the end of this video, you're going to understand exactly why some of the smartest money managers in the world are quietly moving massive amounts of wealth out of cash and into physical gold. Let me start with a question that should keep you up at night. When was the last time you actually thought about what backs the money in your bank account? Most people never ask this question. They assume their money is safe because it's insured by the FDIC, right? But here's what they don't tell you. The FDIC insurance fund has roughly $120 billion in it. Sounds like a lot, until you realize that American banks hold over $18 trillion in deposits. Do the math. That's less than 1% coverage. If even a small fraction of banks faced serious trouble at the same time, that insurance fund would evaporate faster than morning dew in the desert. Now, you might be thinking, that's never going to happen. Banks are stable. The system is solid. But let me take you back to something that happened not too long ago. Remember when Silicon Valley Bank collapsed? It was the second largest bank failure in American history. And it didn't happen because of some massive fraud or criminal activity. It happened because of something much simpler and much more terrifying. A classic bank run. People got nervous, started withdrawing their money, and within 48 hours, the bank was done. Finished. And here's the kicker. The contagion spread. Signature Bank went down days later. First Republic followed. These weren't small community banks. These were major institutions with billions in assets. What saved the system wasn't the FDIC insurance. It was an emergency backstop from the Federal Reserve, essentially printing money to cover the losses. They had to break their own rules to prevent a complete meltdown. Think about that for a second. The safety net you're counting on only works if the government steps in and creates money out of thin air to bail everyone out. And every time they do that, every single dollar in your bank account loses purchasing power. Before we go further, I want to make sure you have access to something that could be incredibly valuable for you. I've put together a free guide that shows the exact strategies thousands of American retirees are using right now to protect their wealth from what's coming. It's in the description below. No cost, no obligation, just real information that could make a massive difference in how you navigate the next few years. Grab it while it's still available. Now let's talk about what's really happening with your cash. When you deposit money in a bank, you think you're storing it there, like putting gold bars in a vault. But that's not what happens. The bank immediately lends out most of that money. They keep a tiny fraction in reserve, usually around 10%, sometimes less. The rest goes out the door in loans, mortgages, business financing. Your money isn't sitting there waiting for you. It's been multiplied across the economy through something called fractional reserve banking. This system works beautifully when everyone has confidence, but confidence is a fragile thing. And right now, there are cracks forming in that confidence that most people aren't seeing. Let me show you what I mean. Central banks around the world have been buying gold at a pace we haven't seen in decades. In the second quarter alone, global central banks purchased 166 tons of gold. That's a 41% increase from their normal quarterly purchases. These aren't amateur investors making emotional decisions. These are the people who run the monetary system, the people who have access to information you and I will never see. And they're moving away from holding dollars and into physical gold. Why would they do that? Because they understand something that most regular people don't. The dollar's dominance as the world's reserve currency is being challenged in ways it never has been before. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to create alternative payment systems that bypass the dollar entirely. They're settling trade in their own currencies. They're building new financial infrastructure. And every time they do a deal without using dollars, the demand for dollars decreases just a little bit more. Now you might think, so what? America is still the biggest economy. The dollar is still king. But here's what history teaches us. Reserve currency status isn't permanent. The British pound was the world's reserve currency for over a century, until it wasn't. The transition happened faster than anyone expected. And when it did, people who held their wealth in pounds watched their purchasing power evaporate. The same thing happened with the Dutch guilder before that, and the Spanish real before that. Every empire thinks its currency will last forever, until it doesn't. Let me paint you a picture of what this looks like in practical terms. Imagine you're a central bank in Asia. You've been holding billions of dollars in US Treasury bonds as your reserves. But you're watching the US government add trillions to its debt every single year. You're seeing political dysfunction. You're seeing the Federal Reserve manipulate interest rates and print money whenever there's a crisis. You're seeing the US use the dollar as a weapon, freezing assets and cutting countries off from the SWIFT payment system when they don't comply with American foreign policy. What do? You start diversifying, quietly, carefully. You start buying gold. And that's exactly what's happening. Gold hit record highs recently, pushing past $3,500 per ounce at one point. But here's what's fascinating. This rally isn't being driven by retail investors or speculators. It's being driven by central banks and institutional buyers who are making strategic, long-term decisions about where to store value. They're not buying gold because they think it's going to go up 10% next quarter. They're buying it because they're preparing for a fundamental shift in the global monetary system. Let's talk about what this means for the average person with money in the bank. Every dollar you hold is a claim on future purchasing power. But that purchasing power is being eroded in two ways simultaneously. First, through inflation. The official numbers say inflation is moderating, but anyone who buys groceries or pays rent knows that's not the full story. The real cost of living has increased dramatically, and it's not going back down. Second, through currency debasement. Every time the government runs a deficit, which is every single year, they're essentially diluting the value of every dollar in existence. It's like adding water to wine. The bottle looks the same, but what's inside is weaker. Gold doesn't have this problem. You can't print gold. You can't create it out of thin air with a keystroke. It has to be mined out of the ground, refined, and physically moved. That's why it's held its value for thousands of years. Every major civilization in human history has recognized gold as money. Not because of some collective delusion, but because it has properties that make it uniquely suited for storing value across time. It's scarce, it's durable, it's divisible, and it's universally recognized. Now, I want to address something that people always bring up when we talk about gold. They say, but gold doesn't pay interest. You can't earn a yield on it. And that's absolutely true. Gold just sits there. But here's the question you need to ask. What good is earning 3% interest on your savings account if inflation is running at 5 or 6%? You're not getting ahead. You're falling behind. You're earning a nominal return while losing real purchasing power. Gold doesn't pay interest, but it also doesn't lose value through monetary debasement. It's a different kind of asset with a different purpose. Think of it this way. Your bank account is like a melting ice cube. It's convenient, it's liquid, you can access it anytime. But it's slowly shrinking. Gold is like a rock. It doesn't melt, it doesn't evaporate. It just sits there, maintaining its mass, regardless of what's happening around it. In a world where everything else is being inflated away, that stability becomes incredibly valuable. Let me tell you a story that illustrates this perfectly. Back in the 1970s, the United States faced a similar crisis of confidence in the dollar. Inflation was raging. The government had just severed the last link between the dollar and gold. People were scared. They didn't know what to do. Those who kept their money in the bank and in bonds watched their purchasing power get destroyed. A dollar in 1970 was worth about 15 cents by 1980 in real terms. But gold went from $35 an ounce to over $800 an ounce. It didn't just preserve wealth, it multiplied it. Now, I'm not saying we're in exactly the same situation. Every crisis is different. But the underlying dynamics are remarkably similar. We have massive government debt. We have a central bank that's trapped between fighting inflation and supporting the economy. We have geopolitical tensions rising. We have a loss of confidence in institutions. And we have smart money moving into hard assets. Here's something else most people don't realize. The gold market is much smaller than you think. The total value of all the gold ever mined in human history is around $15 trillion. That sounds like a lot until you compare it to the global bond market, which is over $130 trillion, or the global stock market, which is around $110 trillion. If even a small percentage of that money decides to move into gold as a safe haven, the price could move dramatically higher. We're talking about a relatively tiny market trying to absorb potentially massive inflows. And here's where it gets really interesting. Most of the gold that exists is not available for purchase. It's in jewelry, it's in central bank vaults, it's in private collections. The amount of gold that actually trades that's available for investors to buy is a fraction of the total. This creates a supply constraint that most people don't appreciate. When demand surges, there's not enough physical gold to go around. Prices have to rise to ration the available supply. We're already seeing signs of this. Premiums on physical gold coins and bars have been elevated for months. Dealers are struggling to keep inventory. Delivery times are stretching out. This is what happens when paper demand starts converting into physical demand. The system gets stressed. And when the system gets stressed, prices move. Now let me address the elephant in the room. What about the risks of holding gold? People worry about storage, about security, about liquidity. These are legitimate concerns. But compare them to the risks of keeping everything in the bank. You're trusting that the bank will remain solvent. You're trusting that the FDIC will be able to cover losses. You're trusting that the government won't impose capital controls or bail-ins like they did in Cyprus. You're trusting that inflation won't erode your purchasing power faster than you can earn interest. That's a lot of trust to place in a system that has failed repeatedly throughout history. With gold, the risks are different but manageable. You need secure storage, yes. But there are professional vault services that specialize in this. You need to think about liquidity, yes. But gold is one of the most liquid assets in the world. You can sell it anywhere, anytime. Try doing that with real estate or a business. And you need to think about price volatility, yes. Gold can be volatile in the short term, but over the long term, over decades and centuries, it has maintained its purchasing power better than any fiat currency ever created. Let me give you a specific example of how this plays out. Let's say you're a retiree with $500,000 in savings. You've worked your whole life to build that nest egg. You're counting on it to fund your retirement. If you keep it all in the bank, earning minimal interest, and inflation runs at an average of 4% per year, in 20 years, your purchasing power will be cut in half. That $500,000 will buy what $250,000 buys today. You'll be able to afford half as much. Your standard of living will decline dramatically. But what if you moved a portion of that into gold? Let's say 20%, $100,000. If gold simply maintains its purchasing power, which it has done historically, that portion of your wealth is protected. And if gold appreciates, which it tends to do during periods of monetary instability, that portion could actually grow in real terms. You're not putting all your eggs in one basket. You're diversifying across different types of assets with different risk profiles. This is where I need to mention something important. If you're sitting on $100,000 or more in retirement accounts, there's a strategy you should know about. It's called a gold IRA, and it allows you to hold physical gold inside your retirement account without triggering taxes or penalties. I've put together a detailed guide on exactly how this works. It's in the description below. It covers the rules, the process, the custodians you can use. If you're serious about protecting your retirement savings from what's coming, this is information you need to have. Check it out when you get a chance. Now let's talk about timing. Because people always want to know, is now the right time to buy gold? And here's the honest answer. Nobody knows. Nobody can predict short-term price movements with any accuracy. What we can do is look at the fundamentals and make informed decisions based on probabilities. And right now, the fundamentals are screaming that gold is undervalued relative to the risks in the financial system. Think about it this way. Gold is essentially insurance against monetary chaos. When you buy insurance, you don't try to time it perfectly. You don't wait until your house is on fire to buy fire insurance. You buy it when things are calm, when it's affordable, when you can think clearly. Right now, we're in a period of relative calm. The system is still functioning. Banks are still open. You can still move money around freely. But the warning signs are there for anyone paying attention. The federal debt is approaching $35 trillion and growing by trillions every year. The interest payments on that debt are now larger than the defense budget. Think about that. We're spending more money just servicing our debt than we spend on the entire military. That's not sustainable. Something has to give. Either they cut spending dramatically, which is politically impossible, or they raise taxes dramatically, which is economically destructive, or they inflate the debt away by printing money, which destroys the currency. Those are the only options. And history shows us which option governments always choose. They choose inflation, every single time, because it's the path of least resistance. It's a hidden tax that most people don't understand. They see prices going up and they blame greedy corporations or supply chain issues. They don't realize that the real cause is monetary expansion. The government creates money. That money flows into the economy, and prices rise to reflect the increased money supply. It's not complicated. It's basic economics. But it's politically convenient to obscure this reality. And here's the thing. Once inflation gets embedded in the system, it's incredibly hard to stop. The Federal Reserve can raise interest rates, which they've done, but that creates its own problems. Higher rates mean higher debt service costs for the government. Higher rates mean economic slowdown and potential recession. Higher rates mean stress in the banking system, as we saw with the regional bank failures. They're trapped. They can't raise rates high enough to truly kill inflation without breaking something important. So they'll try to thread the needle, keeping rates just high enough to slow things down, but not so high that they trigger a crisis. And in that environment, gold thrives. Let me share another historical parallel that's incredibly relevant right now. In the early 2000s, gold was trading around $300 an ounce. Most investors ignored it. They were focused on tech stocks and real estate. But a small group of people saw what was coming. They saw the housing bubble inflating. They saw the excessive leverage in the financial system. They saw the Federal Reserve keeping rates too low for too long. And they bought gold. By the time the financial crisis hit, gold had already doubled. And by the time the dust settled, it had tripled. The people who positioned themselves early didn't just preserve their wealth. They profited enormously, while everyone else was panicking. We're in a similar setup right now. Most people are complacent. They think the system is stable. They think their money is safe in the bank. They're not paying attention to the warning signs. But the smart money is moving. Central banks are buying gold at record pace. Billionaire investors are allocating to precious metals. Institutional funds are adding gold to their portfolios. These people don't move on emotion. They move on analysis. And their analysis is telling them that the risk-reward ratio for gold right now is extremely favorable. Here's another factor that most people miss. The mining industry is struggling. Gold production has been essentially flat for years. It's getting harder and more expensive to find new deposits. The easy gold has already been mined. What's left requires going deeper, going to more remote locations, dealing with lower grade ore. This means the cost of production keeps rising. And when the cost of production rises, it puts a floor under the price. Miners won't sell gold for less than it costs them to produce it. They'll shut down operations first. This creates a natural support level that didn't exist in previous decades. At the same time, demand is surging. We've already talked about central bank buying. But there's also massive demand coming from Asia, particularly China and India. These cultures have a deep historical relationship with gold. They view it as the ultimate form of savings. And as their middle classes grow and become wealthier, they're buying more gold. This is structural demand that's not going away. It's only going to increase over time. So you have constrained supply meeting rising demand. Economics 101 tells you what happens next. Prices rise. The only question is how much and how fast. And that depends on how quickly the confidence crisis unfolds. If it happens slowly, gold will grind higher over years. If it happens quickly, if there's a trigger event that causes a rush to safety, gold could spike dramatically in a very short period of time. What could that trigger be? It could be another banking crisis. It could be a sovereign debt default. It could be a geopolitical event that disrupts global trade. It could be a loss of confidence in the Federal Reserve's ability to manage the economy. It could be a lot of things. The point is, you don't want to wait until the trigger happens to take action. By then, it's too late. Premiums will be sky high. Availability will be limited. You'll be competing with millions of other people who suddenly realize they need to protect their wealth. This is why I keep emphasizing the importance of acting while things are still relatively calm. You have time right now. You can make rational decisions. You can shop around for the best prices. You can set up proper storage. You can do this right. But that window won't stay open forever. At some point, and nobody knows exactly when, the window will close. And the people who waited will be left scrambling. Let me address one more objection that people often raise. They say the government could confiscate gold like they did in 1933. And yes, that happened. President Roosevelt signed an executive order requiring Americans to turn in their gold. But here's the context. That was during the Great Depression, when the dollar was still backed by gold. The government needed gold to maintain the monetary system. Today, the dollar is a fiat currency. It's not backed by anything. The government doesn't need your gold. They can print as much money as they want without it. The dynamics are completely different. Could they try to confiscate gold again? Theoretically, yes, but it would be politically and practically very difficult. There are millions of gold owners now. It's a global market. Capital is mobile. People would move their gold offshore. They would hide it. They would resist, and the government would face massive backlash. It's much more likely that they would simply tax gold heavily or impose capital controls to prevent money from leaving the banking system, which, by the way, is another reason to act now while you still can. Here's what I want you to understand. This isn't about getting rich quick. This isn't about speculation or trying to time the market perfectly. This is about preservation. This is about making sure that the wealth you've worked your entire life to accumulate doesn't evaporate because you trusted a system that's fundamentally broken. The money in your bank account is a claim on future purchasing power, but that claim is only as good as the system that backs it. And right now, that system is under more stress than most people realize. Gold is the alternative. It's been the alternative for 5,000 years. It survived the fall of empires, the collapse of currencies, wars, depressions, hyperinflations. It's still here. It's still valuable. It's still recognized everywhere in the world as a store of wealth. That's not going to change. What's going to change is how many dollars it takes to buy an ounce of gold. And if history is any guide, that number is going to keep going up. So here's my challenge to you. Take this seriously. Don't dismiss it as fear-mongering or conspiracy theory. Look at the data yourself. Look at what central banks are doing. Look at the debt levels. Look at the inflation numbers. Look at the geopolitical tensions. Look at the banking system stress. And then ask yourself honestly, do I feel confident keeping all my wealth in the bank? Do I trust that the system will protect me? Do I believe that the dollar will maintain its purchasing power over the next 10, 20, 30 years? If the answer to any of those questions is no, then you need to take action. And the action doesn't have to be extreme. You don't have to sell everything and buy gold bars. But you should have some allocation to physical precious metals as part of a diversified wealth preservation strategy. 10%, 20%, whatever makes sense for your situation. Just something that gives you a hedge against the monetary chaos that's coming. Remember that free guide I mentioned earlier? The one in the description? If you've watched this far, you're clearly serious about protecting your wealth. That guide goes into much more detail about specific strategies, about how to buy gold, where to store it, how to integrate it into your retirement planning. And here's something special. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pressure, just a chance to talk with someone who can answer your specific questions and help you develop a personalized strategy. This is only available to people who watch till the end, so take advantage of it while you can. The bottom line is this: the world is changing. The monetary system that's been in place for the last 50 years is breaking down. The dollar's dominance is being challenged. The banking system is fragile. Inflation is eroding purchasing power. And the people who understand this are taking action. They're moving wealth out of the system and into hard assets that can't be printed, can't be debased, can't be confiscated with a keystroke. Gold is the ultimate form of financial insurance. And right now, while you still can, while the system is still functioning, while you have options, is the time to get that insurance in place. Don't wait until the crisis hits. Don't wait until everyone else figures it out. By then, it'll be too late. The time to act is now. Protect yourself, protect your family, protect the wealth you've worked so hard to build, because nobody else is going to do it for you.